Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, U.S. stock futures fluctuating this morning as investors await a response from Iran following U.S. attacks on its nuclear sites over the weekend. Iran has vowed to retaliate and kept up attacks on Israel, fueling fears of a wider war in the Middle East. The spike in oil prices fading today as traders wait to see if there will be any disruption into the Strait of Hormuz. Meanwhile, we've got British Airways and Singapore Airlines canceling flights to the Persian Gulf, increasing disruptions in the region. Plus, investors keeping an eye on the Fed this week. Federal Reserve Chair Jerome Powell will testify before the House Financial Services Committee amid growing pressure from the Trump administration to cut interest rates. His commentary will be closely watched after Fed Governor Christopher Waller signaled a July rate cut could be on the table. Also out this week, inflation data closely watched by the Federal Reserve. Will be bringing that to you. And Tesla has debuted its long-awaited robo-taxis. The first robo-taxi trips were limited to a narrow portion of Tesla's hometown of Austin, Texas, with an employee in each vehicle keeping tabs on the operations. The car maker handpicked a friendly crop of initial riders, which featured investors and social media influencers who live-streamed their trips. Inside of 30 minutes into the start of the trading day, let's get a check on stock futures right now. We've got the Dow, the S&P 500, and the NASDAQ all pointing higher right now. Fractional moves as they may be, flat just barely to the upside for the Dow, 0.1% for the S&P 500 and the NASDAQ. If you want to be friendly and round it off to 0.2%, nobody would fault you. Let's turn now to our top stories of the day here as we're continuing to track these futures higher as investors watch the escalating conflict in the Middle East after the U.S. bombed Iranian nuclear facilities over the weekend. The Fed in focus ahead of Chair Jerome Powell's testimony before Congress this week. And, the third to round out the trifecta, oil prices wavering as investors weigh supply disruption concerns. So let's break it all down. I'm joined now by markets reporter Josh Schaefer, senior reporter Ali Canal, live from the NASDAQ, and Fernando Valle, who is the Hedgeye Risk Management Energy Analyst. Great to have you all here with us this morning. Josh, I want to begin with you, especially as we begin to really get a glimpse of how investors are reacting to what's playing out in the Middle East right now. What has been the kind of cross-the-street tenor that we've heard so far?
Yeah, Brad, so you had that U.S. strike on Iran on Saturday, and sort of the key takeaway that investors thought we might see would be a stocks lower, oil higher trade, but that has not been playing out as oil has not really moved that much higher. We saw a spike late last night, but not a significant spike. And so what strategists have pointing out is the key to this from a stock market perspective is simply where oil is going to go. If oil were to go significantly higher, Morgan Stanley's Mike Wilson, the chief investment officer over there, pointed out that you might need to see WTI at about $120 a barrel. That's significantly higher than what you're looking at on your screen right now with oil in the mid-70s. But you would normally see a 75% to maybe 100% increase in WTI crude from the year prior in order to start weighing on the overall economic story and weighing on stocks. That has not played out to this point. So right now, the street seems to think that perhaps we are seeing an escalation for a de-escalation. That is something that Ed Yardeni pointed out. That might be one of the things we're watching.
And Ali, I heard you ready to chime in as well here as we're standing by and actually we're going to switch gears. We're going to go to Fernando here for a hot second. And it actually dovetails well with what Josh was bringing up there a moment ago, Fernando, in terms of how oil and energy prices could also impact the broader kind of inflationary measures that the Fed is going to be watching for as well here. But we know these readings are going to be kind of backwards looking that we get on the CPI front this week. What's your assessment right now of the early reaction that we're seeing in oil markets and in energy and commodities markets off the back of the conflict in the Middle East?
Yeah, Brett, I think two factors. First, as you said, oil is the biggest weight in our inflation nowcast. So definitely would have a significant impact if it did rise significantly. But it does seem like the market is fading the chances of the Strait of Hormuz being closed. We tend to agree with that. We think the likelihood of Iran closing the Strait of Hormuz is very small, both because it would be very bad for the Iranian economy. A reminder, it's wholly based on oil exports that go through the strait. They cannot move all of their 1.7 million barrels a day through pipeline to the south and bypass the strait. only about 300,000 barrels a day. And they also don't have the military capability likely to hold the strait closed. So obviously, a lot of their neighbors in OPEC would be against closing the strait. Even their main supporters in China, who are the largest importers of crude and natural gas that goes through the strait, would also likely be against any closures there.
And so with the Strait of Hormuz now strictly in plain sight, and we've got the map up here for our viewers just to get a sense of how much traffic flows through there. And then additionally, if you're not able to leverage that waterway, then what are the other options and how much does that change prices?
Well, their other options are to conduct strikes, random strikes within the strait, not close it outright, but make it a lot more challenging and expensive for Western-bound ships to traffic on the strait, and just continue attacks on Israel or potentially U.S. military bases. The one signal that we've said would mean a significant escalation from the west side, from Israel and the U.S., would be bombing Iran's Karg Island, which accounts for 1.3 to 1.4 million barrels a day of those oil exports that I mentioned for Iran. If that was the case, that's the only scenario in which we see Iran going out to try to close the straits, because at that point, they've already lost significant export capacity.
Okay, so let's put a pin in that for a hot second here. Ali, I want to bring you back in. I believe we got your audio all straightened out now. So yes, as we're also going to be watching this week, of course, coming off of the FOMC meeting and decision last week, but also perhaps more clear, a signal for the market participants out there is what the projections were for the long run, perhaps cuts that we've been anticipating, and 50 basis points has been largely the thought process going into and by the end of this year. And so what's going to come this week in terms of inflation data that's really going to sway the Fed's mind one way or another at their next meeting?
Well, we have that critical inflation data due on Friday, the PCE report. We'll also be hearing from a variety of Fed officials later this week, including Fed Chair Jerome Powell, which kicks off his two-day testimony on the Hill tomorrow. So all eyes are going to be on the Fed. And obviously, everything going on between Iran and Israel, that complicates the Fed's path forward, especially when we think about oil prices, as we were just discussing. Oil prices to the upside, that's going to pressure the cost of gas at the pump. That directly impacts consumers. That could lead to higher inflation expectations over the long run. And if that occurs, the Fed might want to stay on hold for longer. There's also another argument on Wall Street that if gas prices are higher and energy prices are higher, that could actually dent GDP, dent demand, and potentially trickle through into the unemployment rate. And then the Fed would have to prioritize the second part of its dual mandate of maximum sustained employment. And if that occurs, maybe they accelerate their pace of cuts. So there's a variety of outcomes here. Jerome Powell himself has said that higher oil prices, typically it's a price shock that doesn't last too long. You can most likely look through it. However, if history is any indication, especially the past year, we know that things don't always turn out the way we thought. So that is something that the Fed is going to be continuously focused on. We've seen a deceleration when it comes to prices. A big part of that has been gas prices falling. So this oil situation could definitely complicate the Fed's next move, and that's what they're going to be closely watching this week.
You know, Josh, it's particularly interesting because as these data points come out, we do know that for the back half of June, and I was looking at some data from a good friend of the show, Ryan Dietrich, over at Carson, and he was basically tweeting out that the second half of June is pretty weak historically, and then even into the early moments of July as well. All that considered, how much can these data points actually move the markets, especially if you have low volume, and then you could get some more outsized volatility potentially?
Yeah, Brad, I mean, I think these data points could be important, right? But I think it's really going to be these data points combined with what we get probably also in July, maybe even in August, right? I think you're waiting for more signs to confirm a direction in terms of the labor market. You're starting to see claims come up, weekly claims for unemployment, but will that maintain for a several month period seems to be a big point of concern and a talking point among strategists. I think that will be something we continue to watch. As far as data from this upcoming week goes, it seems like strategists right now feel like what is happening in the Middle East and the direction of oil will be the driver of markets, at least for the next few days.
And so, Fernando, just lastly, while we have you here, for commodities more broadly, what should investors be watching for in reaction to some of the spillover that's now anticipated as you have different world leaders really chiming in as to now how they need to evaluate what their own measures will be right now?
Yeah, absolutely. I think the two areas, it's Karg Island, as I mentioned, in Iran. That would be significant escalation from the Israeli-US side. And then, as always, China. China is the largest importer of oil in the world, a larger importer of a lot of the other commodities as well. And so they've been trying to stimulate their economy over the past several months. And as was mentioned here, if we get oil prices significantly higher, then the demand side would be much, much weaker. We could even look at the U.S. The fuel demand as well. Typically, over the past 3 years, it's speaking very clearly after the 4th of July weekend. And higher prices here could make that more of a certainty this summer. And so something to watch for. If the drop off is very significant after the 4th of July, it may signal that the economy is not doing so hot.
Josh, Ali, Fernando, thank you. Teeing up today's market activity and all of what we're watching this morning. Appreciate it. Well, the S&P 500 has been within striking distance of its all-time high in recent weeks, but the data shows that investors may have some time to wait before notching another record. Let's send it on over now to our market correspondent, Josh Schaefer, with more.
Hey, Brad. So what we're taking a look at today is how long it normally takes the S&P 500 to make it back to an all-time high after a large drawdown. So we've been talking about the benchmark index being near an all-time high for it feels like over a month now. But what Exhibit A was looking at here in the team over at Compound Media, Matt Ciaramino, what they're looking at is after a 20% drawdown, how long does it take the S&P 500 once it gets within 5% to get back to an all-time high? The average is 3.6 months. It's only been about a month since May 12th when we got there. So normally you would see sort of the choppy trading action that we've seen over the last couple of weeks continue for a little bit longer. And of course, Brad, we were just discussing there are a lot of risks out there right now when we talk about risk on in the equity markets and how things could be impacted, right? You're thinking of headwinds such as the conflict in the Middle East. We don't know what the Fed is going to do. We're waiting to see how tariffs will impact economic data. So if you just spin this data, you take the average, you think 3 months, that gets you to maybe July or August. And in some ways, that doesn't feel too unreasonable as we wait to see how all of these different cross headwinds are going to play out.
All right, Josh, thanks so much for breaking that down. Interesting chart there. We're going to continue to monitor, of course, if we can get back to those new highs here. We got some time. Now time for some of today's trending tickers. We are watching Tesla, Apple, and the airlines industry. First up, Tesla rolling out its long-awaited robotaxis over the weekend in Austin, Texas. CEO Elon Musk says that the company is starting with a small fleet of about 20 cars in Austin and will eventually expand based on performance. The EV manufacturer is charging a flat rate of $4.20 for each ride. Next up, Apple eyeing a potential acquisition bid for Perplexity AI, according to a report from Bloomberg. A deal would help Apple develop an AI-based search engine. The discussions are in early stages among Apple executives and may not lead to an offer. Perplexity recently completed an investment round that valued it at $14 billion. And finally here, international airline stocks, they are falling as the conflict escalates in the Middle East. This after the U.S. entered the conflict over the weekend, striking Iran's underground nuclear facilities. British Airways, owned by International Consolidated Airlines Group, Air France, and Lufthansa are among the major carriers that are suspending flights in the Arabian Gulf. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up on Morning Brief, we break down the price action in crypto markets as Bitcoin takes a hit amid escalating geopolitical risk. All of that and much more coming up on Morning Brief.
It is time now for our chart of the day. I'm Jared Blikre. Bitcoin is back above the $100,000 level after briefly hitting its lowest price since May in the wake of these U.S. attacks on Iran. But looking back at some of its recent moves, they show that the cryptocurrency has a high level of correlation with risk assets and mainly technology. So before we get to that chart, I just want to show you the price action over the weekend. And this will include last Friday. You can see it's pretty negative. And you can see here we are above 100,000, but we dipped below. And that was on Sunday, and that generated a lot of headlines because that is that big psychological number. But let me just show you the year to date and show you why this isn't too concerning for me. What we have here is just technically speaking a bull flag. The long-term trend is still to the upside. We're consolidating, but we're moving sideways to down, as we can see in that chart right there. And over the last 3 years, guess what? We can see this has happened multiple times, most notably in 2024 when we did this for most of the year. That was very frustrating for traders, but not a lot of damage was done technically. Just Bitcoin was basically just treading water. And now I want to get to the juice here. This is the QQQ. This is basically the NASDAQ 100 correlated with Bitcoin, and that is in white here. And you can see it's it goes up and down basically on a scale from 0 to 100, and that's on the right. And then in green, we have Bitcoin, and that is scaled on the left. So let me just show you how some of the peaks have worked out in Bitcoin. There's one, and it's hard to see, but in 2017, early 2018, we had a big peak in Bitcoin. You can see that on your screen right there. Then we had another one racing to all-time highs in 2021. And then we just had another one to all-time highs in 2025. Now, what happened here in each of those circumstances, the correlation with tech dropped precipitously each of those times. And so Bitcoin had basically become detached from a lot of the fundamentals that were driving the overall market. What I'm seeing here today is that Bitcoin is acting a lot like tech markets, and basically the entire market is under pressure right now. So Bitcoin is not catching that safe haven bid. So what we need to see is a new catalyst that allows Bitcoin and crypto assets in general to propel themselves to new highs. But absent that huge catalyst like the election last fall, I don't know if we're going to see that.
Jared, thanks so much. Just 10 minutes inside of today's futures, transitioning into the trading session here, and we've been watching a myriad of reaction here. World leaders are reacting to an escalation in the conflict in the Middle East. The U.S. entering Israel's war with Iran over the weekend, striking 3 nuclear sites. The UN Secretary General writing in a statement, he is, quote, gravely alarmed by the use of force by the U.S., saying, quote, it is critical to avoid a spiral of chaos, end quote. There is no military solution. The only path forward is diplomacy. You've also got Russia and China condemning the U.S. for its attack. The U.K. and the EU also calling for de-escalation and a return to the negotiation table. And a big risk for now, a counterattack from Iran. Investors bracing for retaliation and the possibility that Iran could close the Strait of Hormuz, which transports a quarter of the world's oil. Here to discuss, we've got Jason Ferman, who is the Harvard University professor and former chairman of the Council of Economic Advisors under President Obama. Also joining, we've got Steve Clements, founding editor of the Washington Note. Great to have you both here with us. First, I want to begin with you, Jason. Just what typically would be the conversations taking place inside the administration as this all is playing out, and especially with the decisions that were made over the weekend?
There's nothing that gets the White House's attention more than oil prices. It matters to the economy. It matters to politics. And right now, though, there's not a whole lot you can do outside of, frankly, the national security steps to make sure that that Strait of Hormuz stays open.
And so, Steve, that has been the major sticking point or the major question mark, because now we've started to see some vessels actually, according to reports, rerouting. And so what is the larger implication, the knock-on effect there?
Well, I think that there are a lot of areas that Iran can hit back at the U.S. The Straits of Hormuz are one of them, but there are also a lot of U.S. military assets in Iraq in which Iran has a pretty free hand to operate and can threaten those. And I think the rerouting makes sense because the entire Iran legislature voted in favor of closing those straits. What Iran is good at is not taking on the United States directly. There's no way they can. What Iran is good at is asymmetric responses, asymmetric threats. And that's why a lot of people are concerned not just about the Straits of Hormuz, but a return to a very nasty form of transnational terrorism down the road as part of this package as well.
In terms of the reaction, Steve, that we were just beginning our conversation with, as we're thinking through some of the other large countries who are not only reacting to the actions made and the decisions made by the White House, but also are having ongoing negotiations in the other frame of mind about tariffs. As we're continuing to kind of march towards this deadline of early July, and we've heard the White House talk about, well, if there are negotiations in good faith, then we'll be willing to kick the can down the road. Is this essentially a moment where it says to the administration, okay, we have no choice but to really kick the can down the road if this is everybody's prioritization right now?
I don't think this administration, with all due respect, ever thinks it ever has just one choice. I also don't think it feels constrained by allies. I mean, this is a moment where there was not a lot of consultation with NATO about these actions that President Trump decided to take in bombing these nuclear facilities in Iran. And I think with regard to, tariff strategy, I think, we may find it complex, but I think Donald Trump and the Trump White House has decompartmentalized or has compartmentalized these into, different tracks. And they don't confuse them. I think the rest of the world is caught up in a series of, basically, grabbing the chest and wondering, oh my gosh, what else is going to happen next? And so there's a lot on the table for other nations. But from the president's perspective, I think he's basically barreling. Here's our national security course, in which he shocked a lot of his own base with the direction that he went with Israel in bombing those facilities. And with regards to Europe, Macron and whatnot, he's not playing nice with any of these players. And so I wouldn't expect the president to change or feel compelled to move anywhere with regard to tariff strategy that he's not ready to go.
Okay, and so what is the risk, Jason, then of longer term tariff implications, especially as we have more institutional firms really trying to evaluate what the long run rate will be that will average out at?
Yeah, I mean, we have two supply shocks going on right now. One of them is tariffs. The second one is oil. Both of those have the same impact of raising the price level. Both of those have the same impact of raising the unemployment rate. Neither one of them lends itself to a very good solution from the Fed. Of those two, I'm frankly more worried about tariffs than I am about oil. The United States is a big oil producer. When oil prices go up, it hurts consumers, it benefits producers. It's roughly a wash for GDP and jobs. Tariffs is a much more unalloyed negative. But either way, the Fed is now going to have to be looking really hard at both sides of its mandate and looking really hard at this question of whether the inflation is getting embedded and built into expectations. So far, everything looks encouraging, at least on that point.
And so with that in mind, what would you be watching for? What's kind of your checklist to make sure that we don't tip into a stagflationary environment?
Yeah, I mean, first of all, there's the labor market, and you're just barely seeing a little bit of slowing there, but it's hard to distinguish what is a slowdown in the economy from just a reduction in the number of immigrants, which is a different thing and not something the Fed can do anything about. There's how consumers are feeling about all of this. We've seen some small cracks there. But in general, at a time like this, I frankly favor hard data because soft data can often indicate a level of panic that doesn't actually show up in the economy itself.
Jason, Steve, thanks so much for joining us here this morning ahead of the opening bell.
Yeah.
Coming up on Yahoo Finance, a big programming debut with Opening Bid kicking off in just a few moments. Joining me now, we've got Yahoo Finance Executive Editor Brian Sazi. Sazi, what do we got coming up on the show?
Well, I'm still coming up blasting here, Brad, with the suit and tie on for Opening Bid. Excited to launch your show, but top of mind is really taking the conversations you've had in the morning and drilling deeper. We're going to really drill into defense stocks here in light of what happened over the weekend with the U.S. and Iran. We're really also dig into cryptocurrencies, Bitcoin. You're seeing Circle really make a large move in the pre-market. And of course, Brad, how can we not dig into all things Tesla after that robotaxi launch? Seeing a lot of interesting videos from influencers out there in social media. Looks like the robotaxi did its thing, but I'm trying to figure out, Brad, what does it mean to the profitability of this company looking out over the next 6 months to a year?
All right, Opening Bid up next after the opening bell. Stay with us here on Yahoo Finance, everyone.